The best stocks to buy are often hiding in plain sight. In today's video, I will walk you through 3 powerhouse stocks that are quietly on sale. A tech monopoly critical to AI and chips, an e-commerce giant turning into free cash flow machine, and a search and AI titan pivoting faster than you might think. We are talking about ASML Holdings, Amazon and Alphabet. 3 long-term winners that have pulled back strongly in the recent weeks. If you are looking for high-quality stocks with the staying power and growth potential, this is your signal. Let's dive in. Hey there, I'm Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and India. Please note that I am not a financial advisor. Investing involves risks. Do your own research before investing. By the way, if you are planning to build your US focused portfolio, there are 3 other videos, one covering dividend stocks, other on long-term growth stocks in US, and third one on forever ETFs. I have included link for those 3 videos in the description below. Check it out. Without further ado, let us jump right in. First up is ASML Holdings, the Dutch company that is the beating heart for the semiconductor industry. ASML makes extreme ultraviolet lithography machines that are critical for making most advanced chips that power everything from smartphone to AI service. And here is the kicker. ASML is the only company in the world that makes these machines. That's not an exaggeration. This is a monopoly in one of the most important links in the global tech supply chain. Right now, the stock has pulled back due to a cyclical downturn in the semiconductors and geopolitical export restrictions, especially in concerning China. But long term, here are 4 reasons to hold it for long term. 1. ASML holds 90% of market share in the advanced lithography. 2. ASML's 3 major customers are TSMC, Intel and Samsung. These customers have big plans to build new chip manufacturing facilities in multiple states in US, including Arizona, Ohio and Texas. Globally, new plants are coming up, one in Japan, one in Taiwan, one in Germany. These new facilities need these lithography machines and it would boost demand for ASML in the coming years. 3. As part of the share buyback program, ASML has been buying its own stocks in 2025. This demonstrates 2 things. Company thinks the share is undervalued and believes strongly in the future potential of the business. 4th, P/E multiple has dropped from as high as 58 in 2024 to 29 currently. Few risks to keep in mind. 1. Geopolitical pressure from US-China tensions. This could ease to some extent in the coming months due to recent announcement of US-China trade agreement. 2. Customer concentration with TSMC, Intel and Samsung, just 3 big companies. And it is also very capital intensive industry. Still, if you want to own part of the global chip boom, ASML is arguably the most critical pick and shovel play. Second one is Amazon, a company we all know, but one that many investors are currently underestimating. While the stock has been recovering from its 2022 lows, it is still hasn't fully caught up with the peers like Microsoft. That's your opportunity. Here is what is happening behind the scenes. AWS, Amazon Cloud, continues to dominate the cloud market with 30% plus market share. Retail operations are becoming more profitable thanks to automation and improved logistics. Amazon is investing heavily in AI infrastructure, which could become a major long-term growth engine. Earnings and margins have been growing consistently for the last few years. P/B multiples have fallen significantly from 157 in 2023 to 34 currently. In 2024 alone, Amazon generated 38 billion in free cash flow. But here are some risks to keep in mind. Regulatory scrutiny around monopolistic practices, and then rising competition in both cloud and retail. Thin margins in core business compared to peers. Still, Amazon is no longer just an online store. It's an AI infrastructure and logistics company with a serious long-term potential. Finally, let's talk about Alphabet, the parent of Google, YouTube, Android, and more. Despite being one of the most powerful companies on earth, Alphabet is trading at a very reasonable valuation given its growth profile. Alphabet shares came under pressure recently due to two reasons. One, ongoing search and ad tech monopoly cases in US and Europe. Two, recently Apple executives said they saw search queries decline for the first time in the iPhone. This pullback offers a great opportunity to buy Google at reasonable valuation because though searches on Safari have gone down, Google searches on both Apple and other platforms still growing. Maybe most of the iPhone users, including me, don't use Apple Safari for searches, rather Google app. Though there are a lot of complex questions or searches moving into OpenAI and other AI platforms, they are not really profitable searches like best iPhone to buy, best insurance to buy, best restaurants near me, etc. that generate significant search revenue and ad revenue for Google. I think threats from AI chatbots are overstated. About 57% of Google revenue still comes from Google search ads, which remain highly profitable. But what many investors are missing is how quickly Alphabet is pivoting towards AI monetization and cloud growth. Here is the breakdown. 1. Search is still dominant, but AI overviews and Gemini are being integrated aggressively. 2. Google Cloud is now profitable and growing at a reasonable rate. 3. YouTube, Android, and Google Ads offer a broad digital mode and are huge cash cows. And yet, the market still treats Alphabet like a one-trick pony. Some of the risks to consider. Heavy R&D spending could weigh down on the margins. 2. Antitrust cases in US and Europe are ongoing and could force strategic shifts. But if Alphabet pulls off AI transition, and early signs say it could become the most underestimated tech turnaround story of the next 5 years. So, there you have it. ASML, Amazon, and Alphabet. 3 high-quality businesses with strong fundamentals, wide moats, and the ability to adapt to fast-changing tech trends. They have each faced recent headwinds, but that's exactly why they are on sale right now. Smash that like button if you found value in this breakdown. Subscribe for more long-term investing insights. Until next time, stay curious and invest smart.